There has been a noticeable shift from the Bank of Canada where essentially they've gone from working on fighting inflation to fixing the economy. 2 years of these rate hikes have effectively done their job in bringing down inflation, but they've done it by throttling back on the economy. And now it's time to shift that power back to the economy to help stave off this ever increasing unemployment rate and massive increase in these business insolvencies. So, as of now, the current forecast for rate cuts is actually quite pronounced. And we're going to share what this forecast looks like and what you can expect, especially when it comes to mortgage rates. And if you have a mortgage and you're renewing in the next couple of years, you're definitely going to want to hear this one. Now, just before we get into that, we do have a bit of an exciting announcement that we wanted to share with everybody. So our group has obtained a 30,000 square foot lot in Burnaby, thanks to the multiplex plan. And we're looking to leverage the new provincial zoning and build multiple units on this lot. Plans have been submitted to the city, and the concept is essentially a rancher community featuring single level living homes that are great for both downsizers and retirees and ultimately upsizers as well. People who are looking to live on one level, 1,700 odd square feet with 2 or even 3 garages. In addition to this, we're going to build a low-rise condo development, which again is also all single floor and full floor living is being proposed. If you are interested in this type of home and in the area of Burnaby, we're hosting an event later this month where we're going to do almost like a town hall style event where we're welcoming the community and people who are interested in these types of homes, i.e. prospective buyers, to check out what we're basically proposing and give feedback on the design concepts and the housing types and what we have planned for the design of the neighborhood. So if you are interested in this and what the multiplex plan is doing to that neighborhood, give us a call. The event is going to be on Sunday, August the 18th, and we can secure your spot. Just reach out to us at the link below, and we will make sure that you are invited and get to hear all about this project. Excellent. Okay, let's dive into today's episode with, of course, first off, the Bank of Canada rate cuts. Do you remember back at like the end of 2023 and even going into the beginning of 2024, how it almost felt like every month was going to be the rate cut, but it just kept getting kicked further and further down the road? Like in January, everybody thought it was January. And then in February, everybody thought it was February. And then it just got pushed back until ultimately we didn't see a rate cut until June. And then we saw one in July. And now ultimately the whole sort of sentiment has shifted. And as of today, the implied rate cuts for the rest of the year, well, there's one plan for every single meeting. Plan. This isn't by the BOC. This is more of the markets talking, but you get the idea. And yet that continual downward trend looks like it will continue until hitting about 3.5% overnight rate somewhere around March of next year, of 2025. Things have shifted quickly in the States as well, where now markets are predicting a half point, a 50 basis point cut at their next announcement in September. And why? Why has this shift changed so dramatically? Well, part of it is, of course, based on the huge drop that we've seen in Canada in the core inflation metric. On top of this, we've got consumer expectations and business expectations all think that inflation is dropping and basically under control. So these talks have, of course, now shifted from inflation concerns to economic concerns because business insolvencies still skyrocketing at an absolutely alarming rate. And of course, those are almost at global financial crisis levels. They're really high right now. Plus, when we look at headline inflation with that good old mortgage interest component stripped out, love it or hate the way that you can look at that, but ultimately that pushes inflation down to 1.4%. And why do we look at it like that? Because the mortgage interest rate amount is largely controlled by the overnight rate, meaning they can bring that down. So looking beyond just 2025, if you look 3 years out and 4 years out and 5 years out, as of today, based on the economic data we have, it does look like those interest rates, the overnight rate is going to hover somewhere between 2.5% to 3%. That's kind of going to be the new baseline. At least that's what it looks like today. And understandably, mortgage rates are going to come down with that. So what does this mean? Well, I guess I'll share a personal story. What would I do today if I was renewing or obtaining a new mortgage? And no, this isn't mortgage advice. Get that advice from your lender, from your bank, etc. But for the sake of this of this segment here, what would I do today? Honestly, I would go and get a variable rate mortgage for a couple reasons. One, the data is showing that we're going to experience at least 18 to 24 months of rates coming down. And two, it's very easy and inexpensive to move that into a fixed rate mortgage at any time. As of right now, just to give you an idea of how far things have come down, variable rate mortgages peaked at around 6.2%. And as of today, they're sitting around 5.6%. Fixed has dropped even further. Fixed peaked at around 5.8%. And today you can get a fixed rate mortgage around 4.6%. Clearly, things have peaked when it comes to mortgage rates and are trending down. And I think a lot of people are now going to start positioning themselves accordingly. So have that talk with your lender if you have a renewal coming up in the next couple of years, and maybe start planning on the best way to position yourself now.
Yeah, and I mean, even this week, Dan, there was discussions from the U.S. Federal Reserve. Well, I don't know if it was actually from the Federal Reserve, but there was rumblings down in the U.S. of an emergency rate cut even before September. And that was due in part to the fact that the U.S. expected to produce 185,000 jobs, but actually produced 39% less at 114,000 jobs. So, that actually ended up sending things like the Japanese stock exchange into a tumble, and places like South Korea halted trading because out of fears the U.S. was moving into a recession, and that still may be the case. With that being said, it kind of seems like over the last year, the Bank of Canada, well, I mean, maybe more like the last 6 months, the Bank of Canada has been more concerned about the state of the economy than necessarily the state of inflation, whereas I feel like the U.S. Federal Reserve was all about inflation and is now shifting that focus onto their overall economy. With that said, let's start to look at some mortgage arrears, because this is also a telling sign of things to come. But as a reminder, the mortgage arrears rate actually improved from April over March, decreasing 0.19% to 0.18%. In May, it bumped back up to 1.9%. But, all said and done, not a huge change here. And it's pretty incredible to think, after 2 years of rate hikes, and arrears have only increased 0.05% from their all-time lows, which was achieved in mid-2022. So where does it go from here? Well, as we are now in that cycle, I would expect arrears rates to increase to some degree as well. Keep in mind, the arrears rate could still double from where it's currently at, and then it would only be in line with long-term averages. So one metric to keep an eye on here specifically is the unemployment rate. And there's a great chart that we'll share if you're watching this on YouTube, and it shows how it correlates directly the unemployment rate and the arrears rate. So with the unemployment rate, as it's increasing, we expect the arrears rate to increase with it. I mean, naturally, if you can't pay for your mortgage, you're going to go into arrears. So the question then turns to, how high will each of these go? And before further rate cuts take effect and both start to drop again, right? So they correlate. So right now they're on the way up. It'll peak at some point here in the next 6 to 12 months, and then it'll turn back again. Realistically, like I just said, this could take about a full year, but we'll keep you updated on both as they progress here.
Another thing, another topic, another metric to keep you updated on is population growth. It's been a hot button issue for a couple of years here now, understandably, and it's still worth discussing because Q2 data is in and it is a new record, a new all-time high, up 1.2 million new people in population growth year over year in Canada. It is only slightly higher than Q1, so that rate of growth is clearly tempered here, but it's also likely going to probably start to peel down, right? I think we're going to roll over pretty quick here, probably even in Q3. So we've likely peaked in the rate of population growth in Canada here. Understandably, non-PRs, non-permanent residents, are still the vast majority of the population growth that we've seen. That 1.2 million non-PRs equate about 810,000 of those. Again, we're going to share a nice chart here for those watching on YouTube, and it does include a line that shows the natural increase of population growth. Well, in Canada, it's actually a decrease. Canada's natural population is decreasing and has been for over a dozen years, over 14 years. And that points to why immigration is kind of, or technically, in some people's opinions and views, important. Because in order for a country to grow, to have a bigger economy, to have bigger GDP, you do need a level of population growth. Again, maybe 1.2 million a year isn't the right number in Canada, at least not based on the ability to create infrastructure and homes and education and medical systems that can keep up with that level of growth. But you get the idea here. If we had zero immigration in Canada, we might start to see an economy that emulates Japan, because their population is shrinking and their economy is going with it, and so is their dollar and their housing market. Either way, let's keep in mind too that this not obscene, but this excessive rate of growth, if you will, in the last few years that we've seen, the government has identified it as being a bit too hot, if you will, and they've mandated that they're going to reduce the amount of PRs in the country from, I believe it's 7% of total population today, down to 5%. Is it possible? Well, it's starting to happen. When we look at temporary residents, new applications, and the extensions that have been requested and approved, well, basically, that's down to zero now, dating back to about August of 2023, almost a full year. That used to be a very high number, and now it is essentially zero. It's even gone negative as of late. So that's understandably going to start to slow at least the growth, and maybe start to reverse it a little bit. And as mentioned, immigration is also very much a hot button issue. In fact, it's now discussed more in Canada, apparently, than climate change is. And there was a recent poll that stated 1 out of every 2 Canadians, I guess 50%, think that there are too many immigrants coming to Canada. So again, it looks like that sort of 1.2 million per year is not the quote unquote right number. And not that anybody knows what the right number is, but understandably, if it feels like everything has gotten a little out of control with pricing, with not having enough housing and education and schools and hospitals for everybody, it's because it looks like the amount of growth outweighed the amount of infrastructure to support it. We've talked about it quite a bit here, but again, it's we haven't gotten out of the woods yet in a sense, whereas of course we just hit another record last quarter, but I think quite strongly here that this is the peak. We will see that number reduce quite dramatically over the next few quarters.
Interesting to hear, demographically speaking, outside of immigration, that the population continues to shrink. And I think that's due in part to the fact that, most couples are having less children than they were, say, 2 or 3 decades ago. And that's probably due in part to the cost of buying a house that is big enough to house those children, the cost of bringing them up, all that kind of stuff. And people are arguably having children much later in life than they were before. So I think it's really interesting to see that demographic change. And I truly believe there's economic fundamentals behind the reasoning for that as well. Nevertheless, that's a much bigger podcast and a way bigger topic. So I'll keep moving on here. And let's have a look quickly at the mortgage market. As Dan mentioned earlier in the podcast, originations have been increasing. In fact, they're above all levels from 2016 to 2019. So we know now that there is a sideline of buyers that are getting ready to start looking at buying again, especially as these rates continue to fall over the next year and a half. 3 to 4 year fixed mortgages are still the most popular, and mortgage renewals most of the mortgage renewals are taking place between 2025 and 2026. This isn't news, but I think what's interesting is that a lot of what people thought they might have been renewing at versus what they will be renewing at could be lower than expected, especially if the Bank of Canada continues on this path. You could look at maybe the overnight rate being somewhere around 3.5%. And this should be somewhat more manageable than the 4.5%, 5%, even 6% that we've been going through over the last couple of years. So it should be more manageable for those renewing, especially considering when a lot of these mortgages were first originated, the overnight rate was 0.25%. So quite a shift from where we were, but hopefully not as bad as where it could have gone.
The mortgage originations chart that we're sharing on YouTube is quite interesting to look at as well. This is dollar figures as well, right? So it's not necessarily the amount of mortgages, it's the cumulative dollar amount of those mortgages combined. Now, obviously coming off of the COVID era spending spree, everything feels slow. And the numbers show that, right? It's fact, but very interesting to see that in this chart, the dollar figure of originations, it's never dropped below where it was for the last 8 years now. It grew and grew and grew, and then it kind of flatlined, and then went ballistic during COVID, but it never dropped to the level that it kind of feels like it does, anecdotally on the streets here. But either way, to see that tick up at a time when we know mortgage rate cuts are looking to continue here, kind of setting up for what may happen. I don't think it's going to be any type of blow off top again, but we might see things increase slightly as time and cuts go on. And how does inventory affect all this? Because it's always interesting to track what's happening with inventory, because that really moves the market, almost as much as interest rates can. So nationally, quick reminder, the Canadian inventory bottomed out in 2021 with only 90,000 listings available. It was rock bottom, and that's when, of course, prices were going rock top. Not that that's a word, but you get the idea. They were going up. The amount of inventory has increased dramatically. It's up to about 160,000 active listings across the country now. Sounds high, but let's pull back a bit here and look at the big pictures. We always do for reference, and we're still well below these long-term averages. If you remember, it was only back in 2015, 9 years ago, when there was 250,000, 250,000 active listings. And guess what? Prices were going up then too. And now we have 160,000 and a lot more people in the country than we had 9 years ago. So even with these 2 years of rate hikes, etc., even with people having a tough time paying their mortgages, even with all these condo completions in places like Toronto, we're not seeing this blowout of listings nationally. Yes, it's going up, and yes, we don't know when the top of that cycle is going to be, but we're still 90,000 away from the old sort of top that we saw 9 years ago. When we look at it province by province, like I just mentioned, Toronto in Ontario, of course, they currently have an all-time high in active listings, 29,000, something like that. Just an absolutely huge number. Vancouver, we're at about a 7-year high right now. Okay, we're nowhere near the all-time high that we saw back during the GFC. Provincially, only Alberta and Saskatchewan are actually seeing their inventory numbers trend downwards. Every other province is seeing active inventory up, and increasing. But on top of this, and to kind of further accentuate this point, new listings are still well below the 10-year averages nationally. So while there's the odd spike here and there, there's no, I guess, again, blow off sort of top here of people actively listing. It's not just rush to the marketplace that many expected during these rate hiking cycles here. So looking forward, as we go into fall here, we have what's kind of starting to feel like a bit of a stable marketplace, right? There's no crazy listings coming. We've got good inventory, but not near the peak and definitely not near the bottom. And we know where interest rates are likely going, based on today's metrics. And, we're just not going to see hysteria on either side. We're not going to see buying hysteria, and we're not going to see selling or listing hysteria. It's just going to kind of trick along, right? Along with these originations in mortgages ticking up, I think we're just going to kind of see this balanced market grind through for the rest of 2024. Now, again, that's nationally, right? And you can't just say Canadian housing. It doesn't make sense, right? What's a Canadian house? Is it a downtown Yaletown condo? Is it a farm in Saskatchewan? Obviously, hyper-local markets are super important and require focus if that's what you're looking at rather. But you get the idea. I think if we wanted to take a national snapshot, it's balanced and it's okay. And I think it's just going to keep moving. And overall, maybe a slight uptick in sales here. Ryan, what's your take on it?
Yeah, I think you've illustrated, there's a short run and a long run scenario here, and they don't quite correlate. I would say the short run is probably going to be somewhat less stable than maybe we've seen in the past, but the long-term projection hasn't really changed. I mean, the only thing that's really changed with respect to the long term is that we have far more people, and we haven't seen that level of listings rise, standing inventory rise to meet that obligation. So, while there's a short run pinch, and things will be it'll be to the advantage of those who are well educated or willing to take a risk in this environment versus the long-term picture, which I think hasn't really changed. The narrative is that we just don't have enough houses for the long term. And that may very well be the case so long as we continue to bring people in, so long as these people with PRs roll over, or sorry, who have non-PRs roll over into a PR position and may end up buying homes. So, it's interesting to see the short run issues. I think they're temporary, but the long-term narrative, I don't think has changed dramatically. So, as we've always said, don't ever be buying a house here for 1 or 2 years. You should always be buying for 5+ years, if not more. And you're likely going to be okay.
Perfect. Well said. And as mentioned, if you have interest in buying a home, thanks to the multiplex plan, we are taking a single family lot and turning it into 8 family homes. We'd love to show you what we're up to. Book a meeting with us. We'll bring you to the event, and we're really excited to help bring more homes to market thanks to this plan. Thank you, as always, for tuning in, watching. Have a wonderful weekend, and we hope to see you here next week. Bye.